Netflix stock just dropped more than 6% after the company missed Wall Street's expectations on both revenue and profit. The streaming giant is facing a rare financial stumble, and this time, the problem came from an unexpected source: tax trouble in Brazil. Let's break down what really happened and what it means for investors. For the latest quarter, Netflix reported $11.51 billion in revenue, slightly below both analyst estimates and the company's own guidance. Earnings per share came in at $5.87, missing forecasts of nearly $7. A notable gap that sent the stock sliding in pre-market trading. Even so, revenue was still up from $9.8 billion a year ago, showing continued growth, just not at the pace Wall Street had hoped for. The shortfall wasn't driven by slowing subscribers or weak content. It was due to an unexpected expense tied to an ongoing dispute with Brazilian tax authorities. That charge lowered Netflix's operating margin to 28%, below its own forecast of 31.5%. The company said it would have exceeded its margin target if not for that one-time hit, and doesn't expect it to affect future results. Despite the earnings miss, Netflix is projecting a strong rebound next quarter, forecasting nearly $12 billion in revenue and higher earnings per share. And when it comes to content, engagement remains strong. The Canelo versus Crawford boxing match drew over 41 million viewers, making it the most watched men's title fight of the century. Meanwhile, K-pop Demon Hunters became Netflix's most viewed film of all time, with a massive 325 million views. Netflix's ad-supported plan, priced at $7.99 a month, is also gaining serious traction. The company reported its strongest ad sales quarter yet and expects ad revenue to double in 2025, driven by a new partnership with Amazon's DSP platform, which allows advertisers to easily buy Netflix inventory across multiple markets. Executives say this integration could become a cornerstone of Netflix's long-term growth. According to J.P. Morgan's Doug Anmuth, Netflix's advertising business could grow from $1.4 billion in 2024 to nearly $4.2 billion by 2026. But analysts remain divided on whether the company's valuation, still around 45 times forward earnings, is justified, especially with rising competition from AI-driven content platforms and mixed investor sentiment. Shares have climbed 40% this year, but have recently lagged behind tech peers as investors weigh risks versus rewards. So, while Netflix stumbled this quarter, its fundamentals, from strong content to expanding ad revenue, remain solid. Is this a buying opportunity or the start of a slowdown? Let us know what you think in the comments. Thanks for watching, and don't forget to like, subscribe, and stay tuned for more breakdowns on the biggest stories in business and tech.